Interest rates continuing to spook investors with the VIX hitting its highest level since July. Major averages are back in the red. The Nasdaq, the worst performer, down about 0.6% after coming off its worst week since March. Joining us now here at Post 9 is UBS Director of Floor Operations, Art Cashin. Art, great to see you today.
Thank you. Good to be here.
It's actually Columbus Day. It's a holiday. Bond markets are technically closed, but is this what's continuing to drive the action to the downside in equities today, this rise in rates?
It is, and not only the rise, but the rapidity with which it occurred.
Yeah.
And we've achieved the long talked about 3.25 level, and the next is going to be 3.5, and then, believe it or not, 3.75. And I get that from people who are much better at charts than I am, like Barry Habib and whatnot. So. The key resistance probably is up at 3.75, but I think if we move to 3.5 and through, it will send a little bit of an electric jolt through the market. The concern is, will the rates go up almost on an automatic basis? That Powell had taken them to where we are. It's going to be interesting. He's trying to get away from the dot plots. He's saying, we'll take the economy as it is, we'll look at it from spot to spot. There's no sense speculating that you need to raise rates another half point in another half year. But that having been said, the dots are still there and you're going to need him to come away. I think what the viewers should also watch very carefully, they resurrected the old hypothesis that the Chinese may be backing away, and that's helping rates go up. Chinese have been a big buyer of U.S. Treasuries. We have a 10-year auction coming up this week. It's going to be very interesting to see what kind of bidding we get on that. Do we get external bidders, people from offshore? If they're much lower than normal, that'll respike that Chinese rumor.
So on the one hand, you got these rising rates, and they're rising very quickly. Increases borrowing costs, incentivizes investors to get out of riskier assets like equities, for example. On the other hand, if you have rates rising because of strong domestic economic growth, is that a good thing?
Well, the theory, there's been a lot of debate, even on your network, people saying, well, it's okay, they're going up for the right reason. But it is a level that you have to worry about. They could be going up for the very right reason, but if they're going a little too fast, this economy is, on the face of it, very, very robust. But it wouldn't take too much to maybe trip up a few sectors here and see the retail area, other areas. Christmas is coming. You're hearing about difficulty hiring, maybe not servicing everybody. So there's a lot of question marks out there. Now the Fed, the market's convinced the Fed's going again in December. But I think they would be well served if they would get across the fact that they're still watch and see. If the economy remains strong, we'll consider it again. We do not have a definite plan at this moment.
It sounds like you're edging into the territory, Art, of saying that the Fed's on the brink of going too far.
I think they are. I've been a bear on yields, if you would. I'm kind of surprised that we got here as early. I thought we'd get to 3.25, but we're about a month early on my look, and that brings me concern, because I think then the market may begin to outthink itself.
All right, one of the things we haven't talked about as much is the fact that you've seen this divergence. I'm getting a little nerdy here, but you've seen this divergence in the transports, which hit their high in the middle of last month and have since dropped, and the Dow Industrials. What are the transports telling us? Should we be watching them more closely?
Well, I think the transports are telling you to be a little careful, as are the divergences and discrepancies between the averages making big highs and 20% of the stocks selling at 52-week lows. The advanced decline line is not matching up. So you're seeing some disparities here. Do they signal the end of the world? No, not likely, but it's interesting you mentioned the beginning of July. We've also, not only the VIX being there, but we've seen several stocks break down to moving averages that they haven't touched since the beginning of July. So we're kind of recycled in here. You want to be careful. The divergences raise concerns, and not an outright signal to sell everything and run for the hills, but it is be cautious. Yes, you're making record highs, but you're not doing with the broad support you usually have.
I mean, Art, if you look at the three sectors that are up right now in the S&P, it's real estate, consumer staples, and utilities. I mean, those are high-yielding sectors that you usually buy when rates fall. That's not telling you that there's this big freak out over rising rates. It's, in fact, quite the opposite. How do you explain that?
You're absolutely correct. And that divergence began just a day or two ago and has increased till now. So you can't go with the other theoretical reason, which was trade wars, because the Russell and the small domestics have been getting hit too. So the market seems to be moving in a manner somewhat inconsistent with the two themes that we've seen going so far.
Maybe it's just a fear of global growth at this point. You saw what happened in China overnight, what's happening in Italy. I mean, there's a few more risk factors internationally.
Yeah, well, there is, and I'm glad you brought up China, because they have now loosened up bank reserves for, I think, the fourth time this year. And so they're beginning to run into some problems. So, you know, I think it might be global. And while we're still waiting on Brexit to be consummated, we now see Italy and other things. So the questions about the European Union remaining as a union continue to pop up.